Debt is a mechanical tool for leverage. Like the lever used to lift this stone, borrowing provides a mechanical advantage that allows a small amount of your own capital to control a much larger financial outcome. This mechanic works by trading your future cash flow for present-day utility. You use the bank's money to gain immediate access to an asset. This trade sets two potential trajectories. Borrowed funds can amplify your ability to acquire wealth-building assets, or they can subsidize a lifestyle that exceeds your current income. Most credit marketing obscures this massive trade-off. By framing the cost as a low monthly payment, lenders shift your focus away from the total volume of interest you will eventually pay. Neutralizing the emotional stress of debt requires looking at the transaction through a single metric: return on investment. Borrowed capital expands the lender's net worth unless the growth of the asset you purchased exceeds the interest rate of the loan. Compare two $10,000 balances over a decade. The left is invested at an 8% return, the right is debt at 18%. Over 10 years, the investment doubles to $21,000, but the debt quintuples to $52,000. Interest amplifies the obligation. We are going to identify exactly which trajectory your current debts put you on and how to recalibrate your strategy. Every loan occupies a specific coordinate on this quadrant. On the horizontal axis, we measure the asset. Does it appreciate or depreciate? On the vertical axis, we measure the cost of the money. Is the interest rate low or high? Mortgages and student loans sit in the bottom right. These are high-utility appreciating assets, typically financed at low rates. This quadrant represents the strategic use of leverage. The core trade-off for these loans is liquidity. You commit your current cash to a long-term obligation because the expected growth of the asset will increase your total net worth over time. In the top left, we find credit cards and high-interest car loans. These combine high borrowing costs with assets that lose value immediately. Borrowing at high rates for a depreciating asset guarantees a loss. You are paying exponential interest on an item that may no longer even exist by the time the loan is satisfied. Investors use a mental shortcut called the Rule of 72 to estimate how quickly these balances will grow. This approximation was recorded by the mathematician Luca Pacioli in the late 1500s. The calculation is straightforward. Divide the number 72 by the annual interest rate of your loan. The result is the approximate number of years it takes for the balance to double. At an 18% credit card rate, 72 divided by 18 is 4. If the interest is left to compound, that debt doubles in just 4 years. If you are saving at 6%, 72 divided by 6 is 12. It takes 3 times as long for your money to double as it does for that high-interest debt to grow. This illustrates the danger of persistent debt, which occurs when a borrower only pays the minimum balance. Minimum payments typically cover only the interest generated each month. This leaves the principal untouched while the lender's compounding interest maintains its momentum. Maintaining only the minimum payment provides short-term cash for daily spending, but it results in long-term financial stagnation. The Rule of 72 demonstrates that time is a powerful force multiplier. It works in your favor when you invest, but it works aggressively against you when you carry high-interest debt. Even strategic debt becomes a risk if the monthly cost overwhelms your cash flow. We measure this through the debt-to-income ratio, or DTI. A safe threshold for non-mortgage debts, like car payments and student loans, is 10% of your take-home pay. Staying below this level ensures you have liquid cash available for emergencies. Including your mortgage, total debt payments should not exceed 36% of your net income. This provides a necessary buffer to prevent insolvency if your income is interrupted. Respecting these limits allows you to finance assets like education or a home without risking bankruptcy during a recession. To evaluate any future borrowing, you should run the proposal through a logical decision engine. Start with the asset. Will this purchase appreciate in value, or is it a depreciating consumer good? If it appreciates, check the rate. Is the interest on this loan lower than the historical return you could earn by investing that same money in the market? Finally, perform the safety check. Does adding this new monthly payment push your total debt-to-income ratio over 36%? If a loan clears these filters, it qualifies as strategic leverage. You are using cheap capital to control an asset that will likely grow. This strategy requires the discipline to delay gratification. You must prioritize the mathematical outcome over the immediate upgrade to your lifestyle. Applying this objective filter reveals the true cost of a loan, regardless of how the monthly payment is marketed. If your current situation already exceeds these DTI limits or includes high interest balances, you need a different strategy. When debt exceeds safe levels, you must stop all new borrowing and deploy an aggressive repayment plan. You are fighting the speed of compounding interest. If the math of the debt has outpaced your income, consider structural changes. Debt management plans or consolidation loans can reduce interest rates and slow the rate of growth. Strategic borrowing expands future wealth. Consumer debt consumes future time. Every dollar you borrow today is a claim against the hours you have yet to work.